Hello everyone, welcome to our podcast explaining how much your tax liability is, as well as payments and credits that go along with that. So let's dive in and look at some of these slides and get some of the highlights that we want to make sure we understand. So there are two ways to calculate how much tax you owe. Once you have taxable income, which is what we talked about in Chapter 1. Once you have your taxable income, you can figure out your tax liability. That's how much you actually have to pay. Now, just a heads up, if you come up with a number that is in any of the problems that you're working on, that's 75 or more than 50% of the taxable income, you know you have made a mistake in your calculations. We do not have any tax bracket that's more than 37%. So you should never have a tax liability that is the majority of your taxable income. So there's two ways that if you do follow them correctly, you'll get the right number that you actually owe for tax purposes. Okay? Now there's the tax table and then there's the tax rate schedule. If your income is under $100,000 taxable income, then you use the tax table. And if it's over, you use the tax rate schedule. As simple as that. Now, the tax rate schedule takes a little bit more work, but both of them work. But the tax table only goes up to $100,000. If you did somebody under $100,000 and used the tax rate schedule, you would may get a slightly different number than you get in the tax table, because the tax table uses kind of a midpoint to calculate the tax. So typically, the way the taxes work, you're going to be paying the highest tax from the tax tables. If you're married filing separately, with the best deal being married filing jointly or qualifying widow. So there's your steps using the tax rate schedule. So we're going to go example here. $150,000. We got to take the single, and these tax rate schedules are at the very beginning of your textbook. So single, make sure we were using the right table first. That's usually the biggest mistake. Students will use the wrong tax table. Then we look at the proper income range. We're talking about income $150,000 taxable income, so we're in this tax bracket. Falls within that range. Okay. So you then subtract the lowest income from that range. Take the $82,500 from the $150,000. Take the difference. Multiply that by the tax rate as indicated over here in the other column. All right, that's 16.2. Add in what you got off to the side here, the tax is. Add the $1,489.50, and you get your total tax liability. That's how you use a tax rate table. Tax table, simply look up the taxable income. Look at the right column depending on what the filing status it is, all right, and it gives you your tax liability. So simpler process, but also you guys be careful you to get the right column and the right row. Income that you're looking for is in between that. That's why it can be a little different, because it's basically the tax for anybody within that range. Okay. So once you know how much tax or tax liabilities, then you apply what we call tax credits. These are places in the tax law where, because of certain things you have done, you receive a credit. This is like somebody else paying your taxes for you. You still owe the liability, but you don't have to pay it because someone else, the credit, if you will, is doing so. There are two types. Non-refundable, refundable. Non-refundable means that you cannot get a refund. You only can reduce your tax liability to zero. So if you have no tax liability, they don't do you any good. Refundable credits, you can actually get money back, okay, for that. So you can have a negative tax liability. That means that the government's going to send you a refund based on refundable credits. You always apply non-refundable credits first and then refundable credits. These are the ones you can see. The list is much longer on the non-refundable. You'll notice one, child tax credit, is really in both places, okay? And the American Opportunity Credit's in both places. Some of it is non-refundable, some of it is refundable, all right? But the largest number is our non-refundable. Okay, so the first thing is if you pay taxes in as a withholding, they take it out of your check, that is applies against your tax liability. And also if you have too much FICA, if you work for too many, a couple of employers, this could happen, all right? Foreign tax credit, okay, if you have income, and it's very specific about how long you have to live in the country and that sort of thing to have that credit. And we'll see there's also an exclusion later, but the idea is that you don't have to pay taxes in the foreign country and the United States as well on the same income. Child and dependent care credit. This is non-refundable. Notice it can only be up to the amount of your tax liability for what they qualified expenses. So basically you have one of your children watched by somebody outside the family so that you can go to work. That's the idea. That's what the credit is for. So that's what you're looking for. There's a little caveat. You have to file joint returns, so married filings separately do not get to claim this credit. Now, who's this qualifying person? It's either a child under 13 as a dependent. Remember our definition of dependent. This is one of those areas where being able to claim someone as a dependent is important. Or they can be older than 13 if they are physically or mentally unable to provide self-care. So they're permanently in some way disabled. Or it could even be your spouse in that case if they are unable to provide self-care. So they expanded that a few years ago to exclude people who, not just children, but also others who are unable to provide care for themselves. So here's where this gets a little tricky. You have to find the lesser of three items. The amount of qualified expenses, that's how much you actually pay to the daycare or babysitter or someone, or $3,000 for one, or $6,000 for two dependents. Okay, 3 dependents does not go up to $9,000. 2 or more is the same at 2 or more are all the same, $6,000 limit, or the amount of earned income. Meaning, if you have no income from one of the spouses, if you're married, or if you aren't married, you can't have a credit unless you have earned income. Basically, the idea is you can't get this credit unless you are making money, and that's why you hired the babysitter or took the child to child care. All right? So, qualified expenses are all what you pay to the babysitter or the daycare situation. They have to be, if you get assistance from your employer, you have to reduce those amounts. And when you have married filing jointly together, which is the only way, if you're married filing separately, you can't use this credit. But if you're married filing jointly, the lower amount of earned income is used. So it's the lower of the two spouses' income. Remember, it's earned income. Okay? Now, they did put a caveat in terms of if you're a full-time student. So if one spouse is working, the other spouse is full-time student, we can pretend that the one that's a student is making some money so that this is still available. So we treat them as if there's one child being watched by a babysitter. It's $250 a month that they're in school, and $500 for if there's 2 children being watched. Okay, so this is what's called deemed income. This does not get added to on the tax return. It's just completely a pretend thing to make sure that those people with full-time students can still use this credit. All right. So example, okay, 4,200. She's got 3 children. Okay, her income is 22,000. All right. Sounds like she's single, so it's just her income that we have to worry about. So remember, finding the lesser of the 3 amounts, where she's got 2 or more qualifying children, so that limit is 6,000. She only paid 4,200 though, and her income is 22,000. That's well above either of the other 2. So she uses the least of the 3 or amounts. Okay. This is a situation where one of them is a full-time student, at least part of the year. So we take the qualified expenses as one option, 3,000 for 1 child, and Mr. Judd's income is 65. Mrs. is no earned income, but she is a full-time student. This is not for 9 months times 250 for 1 child. Okay, so that would be your lowest amount. So that's what you would use to calculate the credit. Now, it's not just that amount. That's the other thing that sometimes we forget. It's a percentage of that amount. And the percentage is from this table. So if your income falls in that range, then you multiply whatever you got from the first step, whatever of the lower of those 3 amounts is, times the percentage listed here. Okay? So back from the Judds, they had the lower of the 3 was 2250. Their AGI is 54,000. That puts them over 43, and there's no limit on the how much they would only use 20%. So it'd be 20% times the 2250 to calculate their credit. All right, $450. That would be non-refundable. Again, only good if they actually have a tax liability. Notice that your income goes up as much high as you want, you still get less 20%. So it's not like it goes away entirely, it just goes down from 35 down to 20 as your income goes up. This whole thing is reported on Form 2441. This is a 2017 form, but it's identical for 2018. Okay. Up here is where you report how much was paid and to whom it was paid. There is a requirement you must give the Social Security number or some tax ID number. So make sure the IRS can match up and make sure that whoever you're paying is reporting that as income. That's the caveat there. Okay, and then this is the children, all right, that you paid for. Make sure that they match up with the return or the dependent of. And then here is where you list the 3 different amounts. Remember, this 6,000 or 3,000, the amount of the expenses, and the AGI, the gross income of the lowest paid spouse or the single parent. Then this line is where you put the lowest of the 3. So you list all 3 and then you put the lowest. Here's where you figure out the percentage, and then this is the credit amount, tentative. This is how much tax liability you have back on the 1040, and then this is the actual credit allowed after considering that it can't be more than the tax liability. Okay? All right, so that covers the dependent care credit. We will start in on higher education credits and look at other credits on the next part 2 of this podcast.